Hope everyone's doing well. This is the Emini end of day review for Monday, May 20th, 2024. And because it's Monday, I'll pull up the weekly chart first because I think it's interesting what's happening here. Obviously, you can see here, really strong rally for the bulls, and all this context aside for now, really strong rally. And then we had this 3-bar sell-off, and it was fairly deep, maybe, 30%, we'll see. And you can see, if this is the start of the rally, this is the end of the rally. Here's a 30%, 50%, and 70% pullback level. And you can see the market pulled back to about 30 and then rallied. Now the problem here for the bulls, this is what I want to talk about. If you look at the end of day review from Friday, I talked a lot about low ones and high ones. And the reason I'm saying that is because this is a high one. And really, you can see it on this chart. I was going to pull up a monthly chart, but you can see it as a high one on this chart. And if you ignore this pullback too, because you could argue these pullbacks over here, every double bottom is a high too. But if you just consider we rallied and then we had a 3-bar trend line break and it fell below the bars to the left. And it's a micro channel down. So the first bar trading above the prior bar was here, the third, and that triggered the high one. Now, if you remember, if you watched, what do I say about high ones and low ones? And then if you think about the context over here especially, the problem with high ones and low ones, so in this case a high one, is you have disappointed traders from the rally here. So you had bulls buying all the way up. There was some unlucky bull who bought up here. Say they bought the high tick of this bull rally, but they knew that this was strong enough that the odds are they can buy, scale and lower, and make a profit at least on their second trade. But anyway, if a bull bought here, and then this is what the market did, what would you do if that happened to you? You'd obviously want to exit at your original entry price, whether you scaled in or not. So the market goes against you, and it's just extra that's a 30% pullback. It's a common pullback level. Plus, you have the first close below the moving average in 20 bars or so, and that's a 20 gap bar buy. And so the market rallied. But the point is, what I'm getting at here is I'm expecting bulls who bought here to be disappointed by this pullback. And I think we'll probably find sellers if we go above last week's high and maybe just at the close of last week. So I do expect resistance in this area. I also think this was strong enough that this may have been the first of a trading range. Maybe we get 2 or 3 legs sideways to down before a second leg similar to this. I don't think this is the second leg for this. I think this is really all one leg. And if you go to a higher time frame, if there was a chart that showed maybe 2 or 3 months at a time, you'd see this all as one leg, and this would just be an intra-bar pullback. So the point with all of this, I think the market's entering a trading range. Maybe it's an expanding triangle. So maybe we do go above the high of last week. And we get an expanding triangle. Maybe it looks something like this. And then we come back and test down here. Maybe we get to the 50% pullback level. But so the point is, going into this week, I do expect more selling. So if we go to the 5-minute chart for the day, actually, let's look at the daily chart real quick, because it's the same point. It's a nested high one. So we have this. This is the same rally that I was showing on the weekly chart. It's a little less steep, but it's a tight bull channel. And then when you get a trend line break of a tight bull channel, the odds are bulls who bought up here can scale and lower and make money. Well, now we're back up here, and now we're getting a high one signal bar on the daily chart. you can see this bar, the 17th, Friday, traded below Thursday's low after a rally, and we have a high one buy signal bar. But I think the context is bad, and if I had a bias going into the day, that's the reason why I would expect more selling today. I think we probably would trade above yesterday's high and then reverse back down. I'm new to TradeStation, so I will get better with the platform as time goes on and I do these more and more. So there's the weekly, here's the daily. The 15-minute and the monthly down here. So the 5-minute today. Overall, I thought it was a pretty interesting day. I also want to start by drawing yesterday's high. I think that's an important price, as well as yesterday's low. So yesterday's high was bar 78. And the low, we're obviously pretty far from it, but I'll put it just because 59. Overall, it was a pretty small day, and before I get distracted and start talking about it, let's get into the 5-minute bar by bar review. So bar 1, you can see it's a bull trend bar closing on its high, well above the high of yesterday. And so far, that's a pretty strong breakout for the bulls. You have a bull trend bar closing on its high, far above the price that it's breaking out of, and it's a pretty good sized body as well. Obviously, the context over here is bad, and you can see we had a buy climax over here that reversed right down, and it's almost a perfect test of that price. Same thing as I was saying on the higher time frames. You had bulls buying the close of this bar. On some smaller time frame, this was a strong rally. And they got trapped on the close of that bar. So the danger with buying bar 1, you need follow through as a bull. So there's trap traders here. If the bulls get another bull bar, that's good. That's follow through. But because of this, it might make it hard for them to get a second bull bar. And in the first 6 bars, I'm expecting a trading range open. So typically, I would not trade on the first 6 bars, and I would just wait. And then bar 2, there's a small doji. It actually was minimum follow through for the bulls. And the reason for that is it's a doji. The open, 33.25, the close, 33.25. What the bulls do, they prevented a bear bar. So yeah, it's bull follow through, but it's minimum. And some bulls might want to be more convinced. Now, bar 2, it's a low 2 short. And you can argue it's 3 pushes up, maybe a wedge. Maybe it's a bull breakout of the channel, and that's low probability. The problem with bull breakouts of channels is that it's a 25% chance, roughly 25% chance you get continuation in the direction of the channel. And more likely, maybe 75% chance, you reverse within about 5 bars, and then we come back and test the trend line. So bull breakout of a channel, trading range price action to the left, and then it's follow through, but it's minimum follow through on bar 2. So the bulls will need to do more to convince more traders to buy. And the bears are selling, thinking the market is expensive, and they're betting they want to sell when it's high, and then maybe look to get out somewhere below. Outside bar on bar 3. So the bulls, the problem with outside bars, even though it's a bull bar, it's another doji. So we had 1 trend bar on the open, and then 2 trading range bars, and it's an expanding triangle on a smaller time frame. And you know the odds are there are traders selling above bar 3. With what I said, 25% chance of a bull breakout getting strong follow through above a channel, especially in context with a lot of overlapping bars to the left. But then you add, it's a nested trading range. There's a trading range overall, and it's a trading range on the past 2 bars. Now this might have been strong enough that the bulls will get a second leg, but that doesn't mean they get a symmetrical second leg, and that doesn't mean they get bar 3 could be their second leg, is the point I'm trying to make. That's the danger with buying up here. Bears, they want to sell, but there's no strong sell signal bar. But I think probably sellers above bar 3. And maybe buyers below, looking for maybe a 50% pullback, and traders buying the channel line for support, looking for a bounce in a second leg. And then we got the bull breakout on bar 4. So traders who sold above bar 3, looking like they're getting trapped on bar 4. So if you sold above bar 3, are you thrilled with your entry bar? Probably not. You might give the next bar a minute or so to prove to you that the bears are in control. So maybe bears sell the close of bar 4 and you stay in the trade or scalp out down here. But either way, it's another bull breakout, but the bulls need follow through. And now you have 1, 2, 3, maybe 4 legs up in a low probability scenario. And just one more thing. On the open, if there's a 50% chance that any move you get is the wrong direction and that it'll fail. And so even if it's a strong rally or sell-off, the odds are about 50% that you will reverse. And is this a strong rally? You have a couple of good-looking bull bars, both bull bars closing on their high, decent-sized bodies, but a couple of trading range bars in there too, and a pullback, so it's 1 pullback, 2 legs up. And then bar 5, the bulls are accelerating. The only problem I have with this is that bar 5 is climactic. You can see I went more than a measured move of the prior bar, bar 4. And that's parabolic. There's also no tail on bar 5, and you can see strong looking bull bars, strong looking rally, but again, it depends what the bulls like. You have to wonder, where are we racing to? Could it be a leg 1, leg 2 measured move? Maybe traders sell around here. If you look to the left at that price, what happened at that price? We have resistance. So the market's getting vacuumed up to resistance. We don't know where the resistance is, and the bulls, they're going to argue, this is a strong bull breakout. Here's the bull breakout, here's the follow through. We're going to get a measured move up to here. And so that's what the bulls are looking for, and I'll draw that. But would I recommend selling the close of bar 5? I would not. I think unless if you do research and you study the trade, then some traders will sell the close of bar 5, betting it's too much, too fast, and it's the open, so the odds of a reversal are increased. And let's look at one more measured move, the measured move of yesterday. You can see that's up there with the measured move of this. So we might be heading here, and that's what the bulls want. And the bears, they're going to try to make the trade fail and maybe come back to the high of yesterday at a minimum. Remember, it's a high 1 buy signal bar, and you typically see high 1s trigger before reversing. So, and there's one more thing. I mentioned this in several of my videos. Most bars have tails, and that means most bars go the wrong direction first and then reverse. And the daily chart's no exception. You can look and see there's a lot of tails. This bear bar, we went up, then down. Bull bar, we went down, then up. This bar, down, then up. This bar went both ways. Even these trend bars, this bull bar has a small tail below, and on a smaller time frame, the market was going down, maybe in a bear channel, and then it reversed and closed near its high. But the point is, most bars have tails, and so this could simply be the upper tail on the daily chart. And that's my concern with buying here. And you combine that with what I've been saying, 80% chance that 80% chance the day has a trading range on the open. And that's why I would be careful trading the first 6 bars. Bar 6, it's a bull bar closing near its high, above its midpoint, but it almost, probably half the bar is overlapping bar 5, and that's a warning that the market's in a trading range. It's a high 1 buy implied on a smaller time frame, and I would expect traders to sell above bar 6 because it's a high 1 and look for a deeper pullback to get long, maybe below 6, maybe at a deeper pullback. And traders run the risk of this reversing on them as well because of the context. And then bar 7, it's an outside down bar. Even though it looks like it closed at the low of bar 6, maybe 1 tick below. And it's good that it closed below the low, but it's also really a trading range bar. The market it engulfed bar 6, really. It's an outside bar, which is an expanding triangle on a smaller time frame. So do you really want to sell at the bottom of an expanding triangle? It's possibly 1, 2, maybe they get one more leg down before a reversal up. This is strong enough that it will probably get a second leg. But if we do get a second leg, I do think there are sellers above bar 6, bar 7, and that would be the high 1 on the higher time frame. And then some traders will sell below 7, being more aggressive that this is a disappointing bar, and the bulls will give up and will sell off back down. But the odds are we'll get a second leg up. And then bar 8, it's a high 1 buy. It's a high 1 buy signal bar. So was bar 7, and so was 6. If that's confusing, it will become more clear the more you look at them and study. But bar 8, the high 1 signal bar, bull bar closing near its high. What about buying the high 1? It's a bull trend. Well, is it a bull trend, first of all? And I have this drawn still. I do think we'll retest this trend line. And we have several measured moves up there, so I'll just keep this one. I don't want the chart to be getting too crowded. We have a high 1, but what have I been saying about high 1s? The odds are there's sellers above. And I don't know if the sellers might come in above the high of the bar. They might come in on maybe above bar 7 or 6, maybe at a measured move, or maybe not until the measured move up here. But the point is, I think there's sellers above, that the market will have to go more sideways to down to find interested buyers. The reality is we're high in an overall trading range market. And as strong as this looks, you can see it could possibly just be a leg in a trading range. And if it is a leg in a trading range, the gaps in trading ranges close. We have several open gaps. We have the high of yesterday. And we have open gaps from bars like bar 63. The market broke out above it, never came back to retest it. Maybe the low of this bear bar never got retested. So there are magnets below as well. But high 1, probably sellers above. And then bar 9. You can see the market triggered the high 1 and then got a doji bar. That's disappointing for the bulls. It's already disappointing for the bulls who bought bar 6. They got this bear bar against them, and they might use any rally to exit. If a bull bought the close of bar 6, maybe we get a bounce and they get a chance to exit. And it looks like that's what happened on bar 9. The close is 53.44 and a quarter, and the high 44 and a quarter. So it was actually a perfect test to the tick of the bar 6 close. So bulls bought, disappointed, they exit at their original entry. So what about selling below bar 9? It's a second reversal, and bulls are disappointed and they're clearly exiting their longs. You can sell below bar 9 because it's a second entry short, and when the market tries to do something twice, like rally once, pull back twice, and fails, it often tries to do the opposite. So traders will sell on a stop below bar 9. It's an aggressive trade, and the reality is it's a low probability trade because the signal bar is small, and even if you use a stop above bar 6, the stop is really close. The potential reward, if this is an opening reversal, you can get 2 or 3 times your initial risk. So it's a low probability trade. But again, with what I've been saying, it's an opening reversal, or it's possibly an opening reversal, 50% chance, and possibly more because breakout of a bull channel and really climactic behavior, and then bad follow through for the bulls. And that's why some traders will sell below bar 10. Some traders will wait for a better looking stop entry. And so we traded below bar 9 and then went outside up. So traders who sold below bar 9, if they're using a tight stop, the odds were, the reality is you're going to get stopped out. But the frustrating thing with bars like bar 10, some traders will sell below bar 9 only to get their stop run on bar 10, and then only for the market to reverse back down and go their way. In this case, the market may rally a little more. This may have been strong enough for a second leg. And the problem for the bulls is that bar 10 could be that second leg. And for bears, they could be trapped out of a good short. So if you sold below the stop order, 9, stop above, it looks like your stop got run by 1 tick, and then you face the risk of the market turning back down. And then bar 11, we traded above bar 10. It's a bull breakout, but failed, closing near its low, so it's a bear reversal bar. The bears see a double top with bar 6. And the bulls, they think it's a weak stop order trade like bar 9, and that they'll buy below it, betting the bears will fail. It's a small signal bar, so again, the reality is it's a low probability trade. It's good risk reward. Your signal bar is small. The market's in a tight bull channel. But again, because it's the open and because it's possibly a trading range, low probability events will be more common. And then again, we traded below bar 11, just like bar 9, and then reversed up. The problem here for the bulls, markets are fractal. And you have to realize, even though it's a bull reversal bar closing on its high, the context is really, the reality is you're late in the market cycle. And the reason I say that, bull breakout 4 and 5, probably strong enough to get a second leg, also follow through on 6. We pulled back on bar 7 and 8, and that's the start of the channel phase. So the market cycle, we break out, there's a pullback, and the pullback is the start of the channel phase. So pullback, channel, but this is the start of the pullback, and then the market evolves into a trading range. All these bars overlapping. And then keep in mind, it is true, when the market cycle resets, we're in a trading range, the odds favor a breakout in the direction of the prior breakout. So bull breakout here, channel, trading range, new bull breakout, pullback, and then another channel up. It's really consecutive bull breakouts, which is climactic, and that's the problem I have with buying here. That's one problem. Another problem, which I think is pretty fascinating, this second leg up for the bulls is comprised of 3 pushes up. And what's the problem with 3 pushes up? You have exhausted traders. 3 pushes up, it's traders call it a wedge. It's a reversal pattern. And so the problem is you have a possible top on 6, pullback, start of the channel. Here's your channel. The market's channeling up on these 5 or 6 bars. But then you have 1 pullback, 2 pullback, 3 pushes up. Leg 3 is far more likely to reverse than get continuation. And you combine it with the fact that it's a high 1. Even on the 15-minute chart, it's a high 1. And so the problem is you have traders who bought here, disappointed. Now you're getting 3 pushes up. Bulls are getting exhausted at a point, at a price where other bulls were disappointed. So I think buying here is dangerous. Still hard to sell. There's no credible stop order sell, and there's been 1 bear bar all day. So because of that, we might have to go more sideways before bears start selling. But I do think we might come and test the bar 8 low at a minimum, because that is the start of the trading range. Or excuse me, it's the start of the channel, which then I said channels typically evolve into trading ranges. So that low is a magnet. So bar 13, the problem with bar 12, like I said, 3 pushes up, and it could even be seen as a high 1. You can say bar 8's a high 1, bar 10's a high 1, and then bar 12's a high 1 signal bar. And it's a nested pattern, so it's a high 1 on a higher time frame. You can see it here on the 15-minute. And we had sellers above bar 12. So bar 13 is a bear bar, closing on its low. So what about selling below 13? I think it's reasonable. I think traders will sell below 13. But where's the trend line break? So the problem here is this is still more likely a minor reversal. And you're going to need to see a trend line break before traders are really going to sell. It'd be nice for the bears if they could break below bar 8, maybe get a double top major trend reversal. But for now, it's really nothing to sell. This is minor. The bears might get here. I think it's unlikely we crash all the way down here from bar 13. It's another small signal bar. The odds are we'll trade above it. And if you did if you sold the close or below bar 13, and then bar 14 was your entry bar, how do you feel? It's not a bad bar, but you're also not excited that the market went your way so far and so quickly. And that's what the market needed to do. It's a stop order, possibly at the top of a trading range. And if this was so bearish, why didn't traders sell? Even another high 1 above bar 14, probably sellers above 14. And you have bears who sold here disappointed we didn't go, and they might buy back their shorts and look to sell higher. And so 15 is vacuuming up, and you can see we traded to a new high of the day. Again, markets are fractal. We had a wedge here. Now we have a wedge here, bar 15. The problem with 15 is you're selling below a bull bar, and the odds are there's traders buying below a bull bar. But it's dangerous because 3 pushes up, possibly high in a trading range. Not only that, but the day structure. You remember on the daily chart, it's a high 1 buy signal bar. The odds are we'll go above it, but probably not go very far before we reverse. This red line is a measured move of yesterday. And if the market's in a trading range and this was a high 1 and there's sellers above, the odds are we're not going to get to this measured move. The bull breakout will fail and we'll reverse back down. So 15, what do? Some traders might sell the close or sell above. And again, some traders might sell 15 as a stop on a stop order below. But it's low probability. Your signal bar is small. We still don't have a major trend line break or a major trend reversal setup. So because of that, it's a low probability trade. Traders will sell, but they need the market to go their way quickly. This channel line or this trend line is the first target. Then you have opens of bars where breakouts began. Those are also going to be magnets. And the high of yesterday, I think, is a big one. Bull bar 16. What happened on bar 16? You can see the tail above bar 15 and the tail below bar 16. Market rallied on 15, pulled back further on 16, and then rallied again. So it's a nested 2 legs up and 3 legs up, and possibly 3 legs here, and maybe just 1 pullback, 2 on a higher time frame. And the reason I'm pointing all this out is because, as bullish as it may look, we have strong bull bars on the open, and that does reduce the probability of a bear trend day for sure. But is this going to be a bull trend day or a trading range day? What does Al say about most days? And the reality is most days have at least 4 hours of trading range price action. That's maybe 80% of days. So not many days are trend days. And then again, I'm really just reminding myself that on the daily chart today, it's a high 1 signal bar. And again, as bullish as this may look, we've only had maybe 2 bear bars today, and then a couple dojis for the bears. It's a bull trend, but it's not. The bulls need to get up here for this breakout to be successful. Go for the measured move. Why is there so much overlap? Why are we channeling? And if we do get a breakout here of the channel line, we know that it's a 25% chance the breakout succeeds. Remember, bull channel means bear flag. And that's the danger. Everything I'm saying there is the reason why I think it's probably dangerous to be buying up here. You're also fairly far above the moving average. Been about 16 bars. It's really been over 20 bars if you look at yesterday or Friday. Whenever I say yesterday, if the prior day was Friday, and I say yesterday, I'm referring to the chart to the left. Now why was I saying that? If you look to the left and use yesterday, Friday, we have 20 bars above the moving average. And the more bars that get added above the moving average, the more climactic and unusual this becomes. Traders are paying above the average price. The moving average is one measure of average. The traders are paying above average. It's expensive up here. And if they're going to do that, they need above average bull price action. And the reality is this is not above average bull price action. I think more likely we'll come back down and test at least the bar 8 low. If not, yesterday's high, this trend line, and like I've been saying, have a reversal day and probably a trading range day and not a bull trend day. Bear bar 17. Another thing about this time of day, when you come up to 11 a.m. Eastern time, or simply bar 18, it's a bar 18 reversal. And bar 18 reversals are fairly common. And what's significant about bar 18, it's really cool. Actually, the principle, again, is fractal, applies to price action on any time frame. And that is most bars go the wrong way first and then reverse and close the other way. And that's just true of, 90% of bars. How many bars can you find that don't have a tail below? Like, you'll find a couple, bear bar, no tail above, but most bars go the wrong way first. And the reason why I'm saying all this is I think it's, for bar 18, most bars find their high or their low by bar 18. Sorry about that. For the daily chart, so most days have found the high or the low of the day by bar 18. It's about 80% chance that's true. But there's 2 problems I have with that today. First of all, the odds that bar 1 remains the low of the day in general is about 20%. Most days the market goes above and below the high and low of bar 1. So if you have about a 20% chance, now at this point maybe it's 35-40%, It's better now, but coming into the day in general, you have about a 20% chance bar 1 remains the high or the low. And what's significant about bar 18 is once you're 18 bars into the day, I'll pull up the calculator, the market has seen the high or the low of the day about 80% of the time. So at this point, the market has either found the low, we're going to continue up, or go sideways but not come back below bar 1, or it's going to be a bull trend day and continue up, or the market's creating the high of the day. It's looking for the high of the day here. We get the high around bar 18, and then we reverse down, possibly all the way below bar 1. The reason I have the calculator is there's 81 bars in a day, and when you look at 18 divided by 81, you're 22% into the bar when the bar has found the high or the low 80% of the time. And so if you apply that to a 5-minute chart, that's 1.1 minutes. And how many seconds is that? It's about 67 seconds. And I think it's cool because it's fractal, and you can see it on the 5-minute chart, you can see it on the daily chart. The bar 18 rule is really a 22% rule. When you're 22% into any bar, the odds are you've found the high or the low. And so the reason, again, why I'm saying all that, now we have a bear bar, 17, high 1 buy, but bear bar, bad signal bar, probably sellers above, maybe 3 legs up. It's a wedge. And for the bulls, it's a bull channel. There's no major trend line break. So bulls probably can buy here. And if it does go against them, they can scale in and exit near their original entry. Bear breakout 18. But why is there such a big tail on 18? Now bar 18 is a bad high 1 signal bar. So we got a breakout of the channel. Maybe it's a breakout of a wedge. And now you have a bad high 1 signal bar. So even though bar 18 was a fairly weak breakout bar, it's really a bull bar. It's a reversal bar because it closed above its midpoint. But since it's a bear bar, in the context, selling up here is probably kind of expensive. You know, the odds are there's sellers above, even if they don't come in until above bar 17. But remember, bar 18, the market could be putting in a high of the day. Another bear bar, 19. It's subtle, but if you think about it, what happened to traders on bar 16 who bought, and they said, okay, I bought on 16, taking a chance, we'll get the bull breakout. And then I don't like my entry bar, and then I scaled in lower on 18, and we're bouncing. I want the market to come back and test the channel line, maybe at a minimum, or my first entry. But then you get another bear bar against you, bar 19, and traders start to wonder, wait a minute, this could be a trading range. Maybe we're going to test the bar 8 low, go sideways before we get a bounce. And the serious risk that traders face is maybe this is the high of the day, and maybe I bought too high and I need to just get out of my position. And so for me, that's what bar 19 is telling me. Probably sellers above, probably sellers below, even if they sell, scale in higher, because this is the first trendline break of this channel, and we may have to retest the highs and get a deeper pullback. It's a trading range. Bar 20, doji, but now it's a 4-bar micro channel for the bears. Is it strong? I think the context is good for the bears, but the bars themselves, there's a lot of buying pressure, there's a lot of overlap. But the bears have controlled every close. The bulls don't have a bull body and 4 bars, and that will probably make some bulls pretty nervous. We might come up and test the apex of the wedge or some price up here, but we did get the breakout of the wedge or the bull channel, and if this is a trading range, we could test all the way down here. And if this is a reversal day, we can come all the way back down here. Bull bar 21, but it's a high 1 above 20 after a 4-bar bear micro channel. The odds are there's sellers above, and that this was strong enough for, again, sellers above and then a second leg. And then 22 could be that second leg for the bears. Leg 1, pull back. Leg 2, getting low in the range. Maybe we fell below bar 10 and found support. We're not quite there. We're also getting close to the moving average. And again, if traders have been buying above the moving average all day, the odds are they'll buy when we get to the average price. If bulls were willing to pay above average all day, then they should be willing to pay the average. Bar 22 is also a bad high 2 signal bar. In general, high 2s, one of the problems is that it's a bear close. And the other problem is, there's disappointed bulls up here. So even if we do go above bar 22, I think the upside may be limited. And this could be tight enough that it's one leg and maybe easier seen on the 15-minute chart. And we get a pullback and a deeper second leg. I think the risk is real that we can come back and test lower on a day like this because of all the trading range price action here. It was a good start for the bulls, but they were unable to keep the market strong in a strong bull trend, and instead we're starting to go more sideways. And we're at that bar 18 number. We're getting to that point where maybe we have found a high of the day, and bulls who are hoping to get up here might have to start wondering, is it more likely we go, here's the current price? What are the odds we go up here before down here? I don't know. Is it 60%? I don't think so. So that's the problem with the trader's equation for the bulls here. 23, bull bar closing on its high. But remember what I said, I think the upside could be limited. Bar 21, if you look at a higher time frame, we have a high 1 buy here, and that's getting triggered by 23. And even if we do have a decent looking bull bar, it's a bull breakout of what? Bar 22, bar 21, and we're still within the range of this trading range. We could have more sellers up here, the bar 16 close. Follow through 24, and that's good for the bulls, but we're still within the range. And you can see there's a tail on 24, and where did 24 test? You can see it's a pretty close test of bar 16. Maybe went one tick above. Maybe it's a test of the high, 47.25, and the high over here, 47.25. So it's a perfect test of the high of 16, not the close. I use the close in general for that retest price, but it can be the high, it could be a little more. It could have been bar 17. But the point is, there's probably disappointed traders over here who scaled in and they're looking to exit their second position at a profit and their first position at break even. They can avoid a loss. Trading ranges are forgiving, and traders who sold low or bought high will usually be forgiven. So bulls bought here, it pulls back against them pretty deep, but then they can avoid a loss. And over here, traders who sold down here, if this is a trading range, maybe they can get out at their original price as well. That's the danger with the bar 8 low in this context. Another bull bar 25, breaking out to a new high of the day. I will say it again, markets are fractal. It's possibly one leg, pull back, 2 legs, pull back, 3 legs. So even if this rally from 23 to 25 gets another bull bar and starts to look pretty strong, the danger is that it's 3 legs up in a trading range, and maybe it's an expanding triangle. But in any case, the point is the upside may be limited. Bear bar 26, high 1, probably sellers above. I don't want to take too long on this end of day review, and I would appreciate actually any feedback if you want me to speed it up or if this pace is good. But I know I'm already about 45 minutes in, and I'm on bar 26. So I'm really only about a third of the way through the day. Anyway, bar 21, high 1. But it's a bear bar, 3 legs up, possibly high in a trading range. And then that's why 27 traders, bulls who are long, they see 26 and they know there's sellers above, and there are bears willing to sell above. But then the market starts to sell off, and there's a sense of urgency, and the traders know we might not stay high in the range for very long. The edge, the edge is basically being taken away. Market moves far fast, and now all of a sudden we could be low in a trading range. And for the bears, they need, in theory, their stops up here, they sell here, they need to get down here. What are the odds we get down here before we're up here? Really, I know they're not worse than 50%. And that's the danger the bulls face. The bears want this to keep going their way quickly, or we could have pretty deep pullbacks. Bulls who bought below 25, maybe they can scale in and make a profit, but the bears, they're hoping for a strong bear breakout here. And then they got follow through on 27. We finally tested this trend line, so I'll remove that. And you can see 1, 2, 3 legs up. We sold off. I'll delete that as well. Now the bulls are hoping we have an expanding triangle, and the expanding triangle takes them up to this measured move. Maybe it takes later in the day. But again, I think more likely we're going to test the bar 8 low and see what's down there. We've now had 3 consecutive bear bars, 4 bar bear micro channel, probably sellers above, and this might be the first leg, or a leg count reset. Some traders will say it's 2 legs. I think more likely we were in a channel here. This was a couple legs down, really a pullback between the legs up. And now we have a leg 1 down for the bears. So if you can recognize when the market has had a strong first leg, or strong enough first leg, and when I say first leg, I mean breakout. So the breakout's occurring in leg 1. When you can recognize when that's happening, you know there's a good chance the market's going to get a second leg in the direction of the first leg. There's about an 80% chance of that. 29, small pullback, and then a bear bar closing on its low. If a bear or a bull, so let's think about it. If a bull bought below 26, say a bull bought anywhere up here, and the market did this, they thought it's a trading range, I can just buy lower and avoid a loss. But why are we getting 4 consecutive bear bars in a tight channel? It's a micro channel. And you have 1 bar that's actually pretty big with a gap. The context is good for the bears. We had 3 legs up, possible high of the day, and possible swing of the day really here. The risk the bulls face, well, there's a few of them, but if this is a trading range, you could fall for a measured move of the trading range. The point is there's magnets below, and at some point, the bulls who bought up here, thinking they can scale in, maybe they did. What are you thinking here? Now the reality is also most breakouts pull back before getting the second leg. So maybe we do pull back and it's a trading range, maybe it's a deep pullback and bulls avoid a loss. But I do think they face a risk here that we could just continue to sell off. We're getting the first couple of closes below the moving average all day. That's good for the bulls, but it's obviously a trading range here, and the moving average plays a lesser role when it's a trading range. And the bears are getting a breakout of the moving average. We retested it and sold off. Possible breakout pullback short. Bull bar 30, it's an outside bar, possibly at the bottom of a trading range. Probably buyers below and sellers above. Probably leg 1 will get a pullback and then a second leg at a minimum. What about buying below bar 30? I think it's too strong down. I think this is strong enough down that you probably want to wait for the market to go more sideways or up or even sideways to down before looking to buy. 31, bull bar, probably buyers below. It's a bad low one, short signal bar, and deep enough pullback that there might be disappointed bears here. But what do I keep saying? I think there's a real risk that bulls who bought here buy above a bull bar, 30. Maybe they exit at 50% and break even on the entire trade. And they say, forget about it. Forget going for this price, my original entry. I'd be happy to break even on the entire trade. So let's see what happens at this price. And the bulls couldn't even get there on 32. That's a warning for the bulls. If this is a trading range, we should get a buy vacuum test, sell vacuum, buy climax, sell climax, and probably just big up, big down, big up. And of course the reality is maybe it's 1, 2, maybe 3 legs up with a pause between. But for the bears, 32, it's a deep enough pullback. Might be 50%. You know there were traders selling at 50%, which is this red line, and you can see that's what happened there. So low 1 short, probably buyers below, and then deeper pullback. Low 1, 32 is a small signal bar, reduces the probability for the bears. But then 33, you can see the market fell far below 32 on 33. So it looks like the bulls weren't even giving it a chance to get here anymore, and they'll exit on this small bounce before they'll exit here, thinking if they don't exit here, they'll have to exit lower. So the bulls and bears are in agreement that we're going lower. This was a leg 1, the bears are in control. Here's leg 2, but it's not symmetrical and we may go lower. And what do the bulls have to buy? A double bottom with 30 and 33, but 33 is a lower low, which it would be stronger if it was a higher low. And it's a bear bar. And it's the middle of a trading range. So is it really ideal to buy here? Probably not. You had bulls trapped up here with a gap. The gap stayed open. The low of 26, the high of 32. So we know bears are selling here and bulls are getting out as well. Another bear bar, 34. Could it be a trading range and we bounce at bar 8? Certainly could. We can get 2 legs down. But when you think about the day structure, I keep referring back to the day structure because of the high 1 on the daily chart. We rallied above yesterday's high here. Then we went sideways, disappointing for the bulls. More and more bulls may give up. We may fall to the open of the day. It's possible that we fall to the open of the day quickly. Outside down 35. Another retest of the moving average. Bears trapped at the moving average. We retested, they get out. Bulls buy the moving average. Market goes against them. We retested, the bulls exit, the bears enter as well. Another decent looking bear breakout. It's a micro channel for 3 bars. Pull back here, but tight enough down, any bounce will probably find sellers. And if it is a trading range day, overall in the day, we're actually fairly high, maybe getting closer to the middle, but this is high, this is low, and you face the risk that the trading range started down here, or maybe here. Again, either way, possible trading range and chance we go lower. 36, so I've been talking about 3 legs. 1, 2, 3 legs up, now 1, 2, 3 legs down. And it's true. But if you look at the legs and you compare them, this leg, you just looking at the bars, probably the strongest leg all day, the defining factor. But then you have this leg, and it's 1, 2, 3 pushes up. You have this leg, it's 1, pull back, 2. That's all within a second push. And then this third push, some traders will see it as leg 1, deep pullback, leg 2. Or maybe it's just leg 1, pull back on these tails, leg 2, 3 legs up. And again, the overall context, the higher time frames, traders expecting this measured move not to be reached, and we come back down here. So what about buying here? The only traders buying here are the ones who, they're bulls saying, okay, expanding triangle, we're down here, we're going to come back and test up here. And it's a valid premise. But the problem you have when you compare these bull legs and these bear legs, this is a really strong bear leg. We have an open gap. Did the bulls have open gaps over here? We had an open gap above bar 3, for sure. Bar 8 did not get to the high of bar 3, so that's an open gap. But in here, there's no open gaps. Every time we went to a new high, traders sold. Bears were able to make money selling above bars. For the bulls, are the bulls making money buying below 30? Maybe if they're quick, but right now, this is definitely tighter than these pushes were. And again, the risk that we fall lower and that it's a trading range day is real. Low 137, but low 1, some traders will argue it's strong enough down. It's a breakout on a higher time frame. Others will just say it's a wedge, and instead of getting the bull breakout, we'll get the bear breakout. And that's also valid because where's the buying pressure? If you're a bull looking to buy this wedge, how many bull bars have you had in the past few bars? Since bar 26, you've had 3 bull bars, one of them really a doji, and then small trend bars. And then you've had about 8 bear bars. So we could easily fall for a measured move of the wedge, and you can see it's right near the open of the day and the high of yesterday. So there's obviously a lot of magnets below. Bull breakout 38, possible. Let me back up actually. So bull breakout of the wedge, but doji on 37, so we went up, paused, we're going up again. So it could be 2 legs up. It's still a lower high with bar 34 or bar 32. And possibly it's a channel for the bears, sellers above bars. And then you have a tail on bar 38. If this is a strong bull breakout, why are traders selling into the close? 39, another bull bar, but similar to up here, where it went up, pulled back, intra-bar, and then up again. That's happening on 39. So 39 is either 2 or 3 legs up on a smaller time frame and a double top. And I said it's a double top. It's a double top with bar 32. Double tops are rarely perfect, so this could be a lower high double top here. 40, bear bar closing on its low. So possible double top. The bears want a break of this neckline down below 36 and a measured move down. And it's a bear bar closing on its low after a nested maybe 3 legs up. So bulls might get below bar 40. I think bar 40 is a bar you need to respect in terms of always in trading. You probably have both bulls and bears exiting. You have bulls exiting and bears entering below 40, so you have traders selling below 40. The bulls were able to prevent the market from falling below bar 40. But now you have leg 1, pullback, leg 2, and possible double top. 42, bull breakout, but bull breakout of what? It's a bull breakout of a few bars to the left, but tail above 41, tail below 42, so it could be 2 legs up. And it's a smaller bar, so if it's a strong bull breakout, why are there tails? Why is there a tail above 41? Why is 42 smaller than 41? And it's also 2 legs up in a trading range. 43 looks like we went outside down, and it's a high 1, but bad context. Again, double top. Probably sellers above 43. 44 is another bad high 1. Then the odds are there's sellers above. 45, another bad high 1. It's a really interesting pattern. You can see we're bouncing on the moving average. The bulls are trying their hardest to get a bull breakout, prevent the bear breakout and get a bull channel. But the market's going sideways over the trend line. There's not support, or there is support, we're bouncing, but the market's also getting squeezed. You can say it's a triangle. The market is contracting, and eventually one side will get squeezed out, and they'll be forced to liquidate positions. And basically, it's breakout mode. And when you weigh both sides, you can say it's 50-50. I do have a bearish bias about this day, as you've heard me talk. So I think there's probably sellers above 45. And if we start to get momentum to the downside, I think a lot of bulls will exit longs and bears will enter short. Outside down 46. In general, outside bars are trading range bars, and you don't want to sell at the low of a trading range bar. But in this context, everything has an opposite. So sometimes outside bars are actually strong breakout bars. We had a triangle, 245, and what does Al say about triangles? There's a 50% chance the first breakout is in the wrong direction, and then you get a reversal, and then a successful breakout the other way. That's what an outside bar would be demonstrating. We had a bull breakout on 46 to the upside, above those three high one signal bars. Then we had a breakout below bar 45 and 46, several bars to the left, and then it's a bear bar closing near its low. So we had a bull breakout of a triangle, now we're getting a bear breakout and follow through 47. 47 is a good bear trend bar. It's not climactic. It opened on its high, closed near its low, and traders are trapped below bar 44. If you bought below 44, this is your entry bar. Really 46 was your entry bar. And bulls were not happy about it and they just exited. And bears knew there was a bull breakout that failed, then a bear breakout attempt. Everybody's selling. This is possibly a leg count reset. We had 3 legs up. Oftentimes the first leg begins before the first leg in the pullback begins before the leg down ended. So that would be leg 1. Here's leg 1. Second push. Third push up. It's really a wedge bear flag. And we're getting trend resumption to the downside for the bears. And the bears, seeing if we can get this measured move here. This probably is not the most efficient way to use this tool. I like using it for a lot of things, but it's tough to have to do that every time. Give up bar 48, so bulls and bears are in agreement. We're going lower. Bulls got squeezed out here, and 48 was obviously a big enough surprise that we're probably going to get a second leg down. It's possibly a second leg trap in a trading range, but again, where's the bottom of the trading range? We haven't even reached this measured move, so I think it's kind of premature to buy, at least expecting a bottom on the low of 48. And you've had a 3-bar micro channel, a big breakout bar, and we haven't reached this measured move, which is getting pretty close. I think the odds are we're going lower. Is it sell to close? I don't think it's ideal to sell the close of 48 because it is possibly 3 legs down and low in a channel, and the market might bounce. Bears short up here might take profits on such a big bar, especially in a trading range. It's common to see sell climaxes. When you get a climax, the expectation really is 1 to 3 bars sideways. And even at the very least, if we go sideways like these 2 bars, that's really what's more expected here. Micro double bottom, 49. Bull bar closing on its high, but small. Bull bar. What I say it about. It might have been bar 2, might have been bar 9, or both. Small signal bars, you're probably going to get your stop run if you put your stop above. And the same applies on 49. High 1, maybe high 2, micro double bottom, but it's minor. and, and you had a strong bear leg. Is 49 really strong enough to reverse the bear leg? Probably not. Inside bar 50. The odds are there's sellers above, but we may have to test the breakout point 36. And another micro double bottom with 49 and 51, another bull bar closing on its high, but still minor. Now we've had three bars sideways after a sell climax. The bulls not bouncing as much as they'd like to be on a channel line. And bears, it might have been two-legged pullback. Bears might step in to sell here. Here's another measured move. This bear breakout using bodies. It's close to the high of yesterday and the open of the day. So there's a cluster of magnets below. Outside down 52. Sellers above 51, even though it was a micro double bottom. What I say about the small signal bars. So even though 49 didn't trigger, same thing applied to 50, 51. Plus, I should have mentioned inside bars are triangles, and they reduce the probability of breakouts. Similar to this triangle up here, we had a bull breakout, then a reversal. Here's a triangle. You can see it easier on a smaller time frame, but I'll draw it here. So if you get a bull breakout, the the probability is reduced. So bull breakout, but then outside down. And again, 48 was strong enough that you'd expect a second leg. 52 could be the start of that second leg. So I think we're always in short, and bulls will exit below a bear bar closing on its low. Bears can enter. Bar 53, it's a weak entry bar for the bears, but it ran stops for the bulls. The bulls are hoping it's a trading range, since here we go below, then back above, maybe an expanding triangle. But if it's always in short and you have magnets below, you run that risk that you're buying too early. It's a minor reversal. 54, another small signal bar similar to 51. So what about a high 2? And then I think the best case for the bulls is a scalp. And the very best case right now is the high of 52. Even if we go above 52, the odds are there's sellers above. We have this breakout point that we're getting far from. We have several open gaps now. Open gap here, actually a perfect test of the gap. The low of bar 26 was 45.50, and the high of this bar 45.50. Bar 46, a perfect test. So it's a negative gap. The tails touch. The tails don't even overlap. But the tails touch, but the bodies don't, and you have an open gap. So open gaps are trapped traders, and trapped traders are fuel. You have bulls trapped here, you have bulls trapped here. So if you're buying here, I don't think you can buy here, really. Outside down, almost outside down 55, going lower. It's possible it's 2 or 3 legs down, and we get a deeper correction, but again, the only reason I'd buy here is to take profits on a short. I don't think you can be buying longs here. And then another bear breakout, 56. It's a breakout attempt of the 60-minute moving average. When you look at the 60-minute chart, this is the moving average plotted on the 5-minute. So we tried to break out below, but had a really deep pullback, and bar 56 actually closed above its midpoint. It's a reversal bar. It's actually a buy reversal bar. It's not a bull bar because it's a bear close, but it is a buy reversal bar closing above its midpoint. We tested magnets like the open of the day, the high of yesterday, and then we actually reversed somewhere in the middle of this trading range here. The market was sideways here, and when the market's in a trading range, traders are in agreement that it's at a fair price. So if we break out away from it, the odds are we'll come back and test it. The same can be said about here. We went sideways for enough bars that the odds are if you buy lower, you could probably make a profit. But you don't know if we're going to come back all the way down here before coming up here. 56 was a big enough breakout. You'd expect another leg even though it closed above its midpoint, because that's obviously not ideal. Other measured moves we could be looking at, maybe a leg 1, leg 2. Doesn't really matter which one you use. The point is there are magnets, profit targets below for the bears, and we had such a big bounce here that we now could test above 52 before going lower. But tight enough, I don't know if I'd be looking to buy yet. Again, I'd be looking to buy to take profits, but not to initiate long trades. Inside bar 57. It's an inside bar, it's a trading range. Probably sellers above, and now probably buyers below. We're at the high of yesterday, which is support. Outside down 58, but it's an expanding triangle, probably buyers below, sellers above. Another inside bar 59, so IOI, it's breakout mode, and similar to a triangle with breakout mode, the first breakout could be the wrong way. And the bears, we had this bear breakout, probably get a second leg, but for now, and I say for now, it's a low 157, maybe 58, the second leg. I do think we'll get a deeper pullback and then a second leg later. And that's the way breakouts usually operate in trading ranges. You get a breakout and then a deep pullback and then a delayed second leg. 60, traders realizing kind of far below the moving average, possibly low in a trading range. Even though this was strong enough for a second leg, do you really want to sell down here? Probably not. And like I said, it was breakout mode. Now we're getting a bull breakout 60. As strong as bar 60 looks, it's completely below the moving average. So I think this is still in control for the bears. I think the bears are still in control. It's always in short. And the risk of a bar like 60 for the bulls is that bears sell rallies when we're in a bear channel and it's always in short. You can argue it's not always in short, but if it's not always in short, it's also not always in long. It's the trading range, which is buy low, sell high. We tested above bar 55, possibly the high of a trading range, and we found sellers above. So that problem with bar 60, strong looking bull bar, but no follow through 61. Inside bar 62, high one buy, probably sellers above. You're also at the moving average, and the bears controlled about 10 bars below the moving average. So the first test will probably find sellers. That's the danger of buying up here. 63, another bull breakout, but it's still minor. 52 is a major lower high, and even if we trade above it, the best case scenario for the bulls here is a trading range. And if you're buying here, you're hoping for a low probability breakout to the upside, and that will test magnets above. But then there's a bear bar, 64. You know the odds are there's sellers above 64. It's 2 legs up. It's an implied leg 2. The low one did not trigger on bar 61, below 61. 60, I should have also mentioned 64 is a bar that always in traders will respect. So if you're long, probably get out below a bear bar, closing below its midpoint. And then another bear bar, 65, high 1, probably sellers above. It's a 3 bar micro channel, and it's a bear bar, signal bar, at resistance, the moving average. More selling, 66. So it's a micro channel getting stronger with magnets below. And the problem for the bears, we really could be low in a trading range. I thought today would be a trading range day, not a bear trend day. This really reduced the probability of a bear trend. So as we get later in the day, I'd like to draw the open of the day in a trading range day, because if it's not a bull trend, it's not a bear trend, then traders will fight over the closed direction of the bar on the daily chart. So that green line is the open of the day. 67, it's a bull reversal bar, but after a 4-bar micro channel, strong enough down that it'll probably get a second leg, and this was strong enough that it'll probably get a second leg. Now, this could be the second leg for the bears because we're in a trading range, and really the bare minimum for a second leg is a test of the low close, which could be either bar 56 or 58. So the closer we get here, the more likely we'll find buyers, because this was strong enough for the bulls that if a bear, think about if you're a bear and you sold down here, the market went all the way up here, you're probably disappointed. You'd be happy if you can avoid a loss if you were the unlucky bear selling the low, but then the lucky bear selling the high. Look where we're bouncing. We're right at the midpoint. The midpoint is where bears would have, and this is just in theory, bears who sold the low tick scaled in at the high tick. We get to that 50% level, the midpoint between the two. It's a scratch. It's a scratch trade. They lose on their first entry, the same amount they win on their second entry. And it looks like traders are buying there. 68, another bull bar closing on its high, but again completely below the moving average. It's a possible pullback of this breakout, and it could just be 50% of that breakout that we're testing. You can see maybe 60%. And then we're getting more buying, 69. Good for the bulls, but not far above the moving average. Really testing the bar 63 low. We're in a trading range, and gaps close in trading ranges. We were in a trading range here. This was big down, big up. So bear breakout, but open gap. Bulls who bought, relieved. Now, possible second leg up for the bulls and bears. This was strong enough for a second leg, but it could also be the second leg for this. I think the odds are we'll go more sideways here. 70. Bear reversal bar, testing the high close over here, reversing down. The problem with selling 70, it's a small signal bar after 3 bull bars up. Odds are your stop would get run. High 1, 71, always sellers above. 72, high 1. Bull bar closing on its high, but bad context. Leg 1, pullback, leg 2, possible nested leg 1, pullback. Maybe we go a little higher, but bulls are scalping. And you can see we went upside down, 73. So leg 1, pullback, leg 2, and then everybody sold. Getting low in the range here. So if we do test the close of 66, I would expect support there, because if a bear sold here, they were disappointed by this rally. Again, the market's getting squeezed, and it's a trading range. And all that means is that it's breakout mode. And you can see there were buyers below on the trend line. It's a triangle. We're getting so late in the day, I would just leave it. In general, I know Ali recommends not trading after bar 72. And it's funny what he says. You've had 72 opportunities to make money today. So if you haven't done it yet, then just leave the last 10. Just give it up for the day, pack it up, and come back tomorrow. 74, bull, reversal bar, and 2 legs down. The problem, the market's getting squeezed. It's a limit order market, and traders are selling above bars, buying below. So if you're entering on a stop above 74, you need the market to go your way quickly. It's a low probability trade. And the bar's not closing on its high, and that's a problem. 75, bear bar, maybe an inside bar. Looks like it has the same high and low price as the prior bar. So just an inside bar is really just a nested trading range. You're getting really sideways here. And again, late in the day, the bears were so close to testing the open of the day, they'll probably want to get there. But right now the bulls have that over the bears. 76, we tested the open of the day. We tested the high of yesterday once again. Now the bears have had 1 leg down with the low close here, and then a test of that low close. The second leg might have been this, a nested second leg, and we might be in a trading range. So if we are in a trading range, we're low in the range, The bears are hoping it's a bear breakout, but obviously nested maybe 3 legs down here, 2 legs down here, 2 legs down here. At support, I think the odds favor a bounce here, and it's probably not a strong bear breakout. 77 bull bar, micro double bottom. It's a weak buy signal bar. If it was a bull bar closing on its high, that might be a more respectable bar that could flip the always in. But the problem with always in here, it's a trading range. So just buy low, sell high. We're probably low right now. We went outside down 78. 77 is another good example of those small signal bars that get their stops run. Maybe you buy above, get your stop run. I don't know if it went above or below first today, but that's usually what happens with small signal bars. And then 78 is a strong bull bar, but only a couple bars left in the day. It didn't quite close on its high, so we're getting high in the trading range, or the triangle. The bulls are hoping we get a follow-through bar, because what is 78 breaking out of? Breaking out of bar 77, but we're not above the bars to the left. And then disappointing follow-through, 79. Disappointment is the hallmark of trading ranges. Plus there's an open gap above 77, the high of 77, and 76. The odds are we'll test there, even if it's tomorrow. And then we tested there on bar 80, and then 81 went a little lower and just bounced because we were getting back into the low of the trading range. I'll keep the open of the day because it's basically the high of yesterday too. We know that's an important magnet. And when we talk about always in, going into the day, bull breakout 1, thought it was always in long, but just a little dangerous with the context. So probably always in long, and no reason to get out of longs here. Obviously another bull breakout. And then we start to go sideways. So it's still always in long, but once you get 2 or 3 legs up, you start having the risk of it being a trading range, and the always in long turns into buy low, sell high, because in trading ranges, always in is basically backwards. When you're high in the range, it looks most bullish. It looks like it's always in long. That's right when the market reverses. So I thought buy low, sell high, all in here. Might have been always in short here. Strong enough leg 1. It'll probably get a leg 2. But you still have to respect we're low in a trading range over here. So when we get there, we might bounce like there. So is it always in short, always in long? I think it's buy low, sell high. I think it's a trading range. But with the overall characteristics of the day, I thought it was more likely we would come back down to the open of the day than go for some measured move up, like the measured move of yesterday. Bear bar closing on its low didn't trigger. Here, I thought it was interesting. I thought it was probably always in short below 46, which it's subtle, but with everything that I said today in the end of day review, I thought if bulls were long and you get bar 46, you probably need to exit longs, and bears know that, so they'll sell. So clearly always in short here, but in a trading range, so breakouts are going to get disappointing follow-through. And then there was a shallow pullback. Why didn't we pull back? Why is the breakout point open? And then another follow-through. At this point now, maybe we've had 3 legs down. So it's getting more dangerous to be calling it always in short, and maybe it's buy low, sell high once again. And it's a trading range. So big down, big up, probably a trading range. We come back down, probably buyers below. So all through here, I really thought it was just buy low, sell high, and not always in long or always in short. For stop order trades today, bull bar, bar 1, closing on its high. It's aggressive. Some traders might buy it, but if you do buy bar 1, you have disappointing follow-through. Traders probably exit. And then bull breakout 4 or 5. Is it by the close? I'm not sure. I thought the context wasn't great. It was parabolic. So as far as stop orders today, really not a whole lot. I thought maybe Traders could take a chance selling below 17, betting it's the high of the day, but it's a weak signal bar, and you need strong follow-through to make up for weak signal bars. And then you get a bear bar with a tail, and then an inside bar. It's not really the strongest follow-through. When you're selling a bar like 17 on a stop, you want a bar like 27, and then even more follow-through, like 48. And when they don't get it, they get out of the trade. So there are stop orders in here the traders are taking, but they exit because they get disappointed. I thought maybe selling below 26 was okay. Double top, possible high of the day, nested 3 legs. But again, a weak signal bar, so the entry needs to make up for it, and it does, 27. But then the follow-through, the momentum really slows up, so traders exit, probably sell higher on a limit order. And then obviously falling more for stop orders. That's a low one short. Traders might take it, but I thought it was also likely we get a second leg up. Hard to sell on a stop on a low one that seems like it's low in a trading range. And then another retest to that low one price, because if it's hard to sell a low one and then it looks good, it actually works, traders get trapped, then what does trapped traders mean? Bulls who bought here, the market went against them, they're trapped into a bad trade. Bears see this low one, they say, it's low in the range. After 2 bull bars, small signal bar, the odds are my stop will get run. We'll probably trade above 32. I better not take the sell, and then it works. So you have bears trapped out of a good trade. Odds are we're going to go back and test that price. And you can see we do here, and that's when traders, bulls exit their losing position, bears exit the winning position, and it goes a little bit more against them, but then of course we sold off. Maybe sell to close 48, but bad context. You really expect 48 has big tails, and when you're in a trading range, first of all, most breakouts fail, but then you're getting tails. Why are traders buying into the close of 48? And when you get a sell climax like 48, you really expect the next 1 to 3 bars to go sideways. I thought it was okay to sell below 52, low 2 short, shallow pullback, hoping for another bear breakout. And then you get the breakout, 56. Some traders might buy the close 56, betting it's exhaustion and 3 legs down, low in a trading range, but I think it's really aggressive. Maybe sell the close 60, but also aggressive because such a strong bar, you know the odds are there's sellers above, but we might have to go a little higher, so probably not sell the close 60. For another stop order, 63 was okay, but it's a tight bull channel, probably have to go more sideways. And then it looks like we're going to retest it and then fall again. And in here, I don't know about stop order trading. I think it's all limit orders in here. So for limit orders, probably buyers below bar 2, buyers below 6, sellers above 7, buyers below bar 9, buyers below bar 11, thought sellers above 17, sellers above 20, 21. Bulls can argue there's buyers below 24, 25, but the context isn't great, and then you get trapped. So if you did buy somewhere in here, let's say you bought the 50% pullback. Look where the market retested to the left. This is 50%. We got close here, and we got to it over here. Sellers above bar 30. This was a strong enough breakout that the odds were we'd get a second leg. Sellers above 31. Sellers above 34. And then probably buyers below 30. Buyers below 39. Sellers above bar 40. Sellers above all these bars. Sellers above here, but not triggering. Bad high 1. Sellers above. 54. Bad high 2. Sellers above. And then all in here, it's really buy low, sell high. So sellers above 55 over here, sellers above 61, buyers below bar 60, got close. Sellers above 68, 69 over here, the close. Sellers above 72, high 1, high in a trading range. Buyers below 75 or 76. Really 77 was a good one. Inside bar, low 1, low in a trading range. And then sellers above 78. Bad bull breakout, high in the range. If anyone has any questions, please drop them in the comments and I'll be happy to look at them and get back to you as soon as I see them. All right, hope everyone has a good rest of their day.